Interesting one from Vanguard, asking if your bond funds contain hidden risks. Let's read what we got here. This is Dateline, April 15th, from the Vanguard perspective for financial advisors, because that's me. I advise financials. Anyway, you should subscribe to the Vanguard's blog. There's lots of good stuff on here. All right. Even before the coronavirus sparked stock market meltdown, a November 19th report by the National Bureau of Economic Research questioned whether some funds are accurately reporting their holdings. The report found that numerous companies misreported their holdings in 2017 and 18 to make their performance look comparably better, claiming to have more AAA and AA rated bonds than they actually did. The author said the problem is widespread, resulting in about 30% of funds being misclassified with safer profiles than when actually compared to their publicly reported holdings. That's nuts, man. So they report their holdings to Morningstar. Morningstar shows you the credit rating of their bonds, and yet 30% of the funds had more risky profiles according to their actual reported holdings than what they reported to Morningstar. And that's not good. If the returns of a bond fund are highly correlated with those of equities, consider taking a deeper look at the portfolio. So they give us here a 10-year correlation of Morningstar categories with the S&P 500. Here's the S&P 500 one. High yield bonds, basically 77% of the time is correlated to S&P. So if the S&P goes up 100, they go up 77. S&P goes down 100, they go down 77. Not sure what a non-traditional bond is. Multi-sector bond, intermediate core plus bond. I have no idea what that is. Intermediate core bond. Zero correlation. And I think that's misleading, actually, because that's over the last 10 years, 10-year return. And over the last 10 years, the S&P 500 just went zhoops. And so a bond that didn't go zhoops, but actually went zhoops, that wouldn't be correlated, but that doesn't mean anything. What happened in 2008 is what matters. And so this in itself is a nothing burger. But we'll read on it because we'll go into it. Correlation measures the degree in which the two variables move together. Yep. Get shock absorption when your clients need it. Core bond holdings aren't the most exciting holdings in a portfolio, but when the economy is strong, other types of bond funds may perform better simply by taking more risk. The risk may include an area of the bond market with lower credit quality but higher yields. Yep. Historically, when stocks drop, core bond funds outperformed. I want to tell you what a core bond fund is, so we'll show that in just a second. Here's a dot-com crash, and this is, I think, a very misleading chart. So they're showing the S&P 500 here, and then they're showing U.S. fund intermediate core bond right there. All right, well, but that's misleading because dividend stocks did pretty well too during that same time period of the stock market crash of 2000, 2001, and 2000. 2002, dividend stocks didn't do great, but in 2001 they did okay. So that's kind of misleading. End of dot-com bust, bear market to March. So that's where they're picking these dates. Why March 19th to October 9th? I don't get why they're this May 21st to September 21st. March 19th, October 9th, 2002. That's odd because then the crash went again. We had a dead cat bounce at the end of the year, then at the beginning of 2003, but then we fell right again, 15% right after the dead cat bounce at the end of 2002, beginning of 2003, until March of 2003. I'm not sure why they're not showing that. Financial crisis, May 19th. That doesn't make sense. What, May 19th, 2008 to March 9th of 2009? I'm not sure what that is. 54%. That May 19th of 2007, maybe? That's weird. I'm not sure what date that is. But S&P 500, it's got to be, well, I don't know. That's weird because the S&P 500 fell 54% total from October 2007 to March 9th of 2009. I'm not sure what that date is, but here's intermediate core bond funds. And I'm going to share. You need to watch the video to know what intermediate core bond funds. And here are other bond funds. So here's multi-sector was down 15%. So while that's not highly correlated, it still got hammered. This is the thing that ticks me off about this kind of stuff. Yes, that's not highly correlated, but they both got hammered. And so a lot of people bought bonds thinking when stocks went down, bonds went up, and you can see that's simply not true here. The debt downgrade, all right, that's okay. And then the last quarter of 2018, stocks got killed and the bonds went up a little bit. All right, so not highly correlated. I'm not sure I'd call it shock absorbers. And again, I'm going to share with you what these bonds were. All right, bond fund should always be low cost. No other way around that. We'll go into the Vanguard core bond fund here in just a second and show you why I think it's I guess that's it. All right, so let's go into the core bond fund. You don't want high expenses on bond funds. That's dumb. That's literally dumb. Don't do that. All right, so let's take a look at the Vanguard core bond fund, and I'm going to show you something that's kind of funny. What we'll see here, if we go to fact sheet, we're going to see, we'll make this a little bit bigger. All right, so we want this expense ratio of 10 basis points. That's good. I like that a lot. High turnover, and the reason I have such a high turnover is because they got over 1,000 bonds. A lot of these bonds are maturing each and every year, which increase their turnover. But that is a pretty significant turnover, which could lead to actually some unforeseen gains potentially. I highly suspect it won't be much, but in of itself, that is a high turnover. But again, when you have that many bonds, many are coming due, you're going to have a high turnover for sure. Let's keep going down. They've only been around since 2016, so that's just, I don't know, it's kind of... But anyway, let's take a look at what this fund is. It's almost like they're using this to raise money for this fund because it's only been around since 2016. Has 1.3 billion in assets. They're definitely trying to get money into this fund. That's all I could tell you. And why would they give an article specifically about this bond fund when it actually isn't even here in terms of their right? Okay, I guess hold on a second. It's not even in their report. It's not that has nothing to do with that specific fund. It just has to do with U.S. Fund Intermediate Core Bond. Is the market as a whole. So it's, I don't know. I don't like that so much. But anyway, be that as it may, it's good fun. I mean, I like it. But let's just take a gander, shall we? Government mortgage and treasury back. So over 55, 60, roughly 60% of this is government bonds of some regard, treasury agency and government mortgage backed. So 60% of this fund is government securities of some kind. And it's kind of like the bond index, the total bond index. It's heavy. 70% is mortgage-backed securities, government bonds, and agencies. And so what that means is at the end of the day, you're getting a little bit more, in this case, you're getting some exposure to corporates for sure, but the bulk is going to be, the predominant amount is absolutely in government bonds. And so the reason I don't like that so much is because the reason right here, 2009, government bonds actually went up. All right, so 2009 government bonds did, and yet this wasn't around back then. So I just think it's misleading. No other way around that, because intermediate core bond funds, I guess they have 60-40 corporate and 60-40 government agencies to 40% corporate. If you really want a truly non-correlated asset, you'd have government bonds exclusively, like Ginnie Mae, for sure. You'd have Ginnie Mae, because Ginnie Mae went up these years. Up. It did not go down. And so that's not shock absorb, but that's going down. And then if you had a multi-sector bond fund, I don't even know what intermediate core plus, but I mean, you're down 18% there. So don't do that. Bonds do not go up when the markets go down. It's just they don't. I hate to say it, but they're completely non-correlated, which means it could happen. Ginnie Mae or government bonds, on the other hand, is always a flight to safety. When the markets get hammered, people go to safe assets, which is government bonds. So anyway, I thought you'd like that. I'll put a link in the show notes. I'd love to hear your comments. Thanks now.